Hey peeps, welcome back. So today we're going to be talking about NAV erosion and how it works in correlation with YieldMax funds and any other covered call ETF out there on the market. And also how to be profitable and what our take is on things. Let's get it. So the reason I bring this video up is I'm actually going to scroll down here. Context NOP, this is for you. He says, or she, I'm not sure which it is. Can you make a video on what exactly NAV erosion is, and is there an example of a fund that experienced it? So we're going to go ahead and get into that right now. The first thing that I want to pull up here is, this is on Seeking Alpha. It talks about YieldMax and possible NAV erosion. There's a whole article here. I will leave this in the link in the description for you guys below. So we're going to go pretty in depth into this video. Please stick with me if you guys want to learn more about this. I'm not sure how long this is going to take, so let's go ahead and get into it. They say RYLD, low NAV erosion, and occasional tax benefits. Now, keep in mind, this is a covered call ETF, okay? So this is similar to YieldMax, but the payout is not that high, and YieldMax is single stock ETFs, whereas Global X does equity index-based covered call ETFs, like the RYLD would be for the NASDAQ, QYLD would be, RYLD would be for the Russell 2000, QYLD would be for the NASDAQ, and the XYLD would be for the S&P 500. So it says Global X Russell 2000 covered call ETF seeks to generate income by selling at-the-money covered calls on tickers in the Russell 2000. Distributions are currently paying a trailing yield of 11.36%, portions of which can be paid out as return of capital. As far as I know, return of capital is not taxable, and the reason why is because they're basically, I forget exactly how return of capital works. I had to deal with this last year on my taxes, but it's difficult to explain. Let's actually, I don't want to get this wrong, so let's just Google it. We'll say, what is return of capital? Okay, so return of capital is a payment that an investor receives as a portion of their original investment and that is not considered income or capital gains from the investment. Note that a return of capital reduces an investor's adjusted cost basis. Once the stock's adjusted cost basis has been reduced to zero, any subsequent return will be taxable as a capital gain. So basically, they're paying a portion of your funds back to you in the form of a dividend. Once your cost basis hits zero, then you start to pay taxes on whatever you receive after that. I'm not a tax professional. Again, when it comes tax time, talk to your tax advisor about this, ask them questions, pick their brains, see what they can tell you. So it says the fund mitigates some of its long-term NAV erosion by retaining a portion of the premium collected. Volatility can be hedged by entering a short position, and I'm not really sure what that is. So they're rating RYLD a buy. So we can scroll down. I'll leave this in the description for you guys so you can read yourself. So NAV erosion. Covered call strategies are notorious for suffering from an erosion of their net asset value over longer time frames. By watching interviews with the fund manager, I was able to find out that Global X mitigates this somewhat by handing out distributions that are sized so the fund can retain a portion of the premium collected. They either pay out half the value of the premium or 1% of the NAV, whichever is lower. This is comparable to a shareholder choosing to only reinvest a portion of their dividends. And then it goes into some other information here that I'm not going to read because that doesn't tie directly into NAV erosion. And we got some other metrics here. You guys can look through all these. And it goes into a piece about hedging volatility. Anyone wanting to mitigate volatility can look into producing a low volatility couple by entering an inversely correlated position on another asset. Before I talk about leveraged ETFs, I need to issue a warning. Although their daily performance is quite predictable, enough retail investors have misunderstood the long-term behavior that the so on. You get some issues or warnings here from the SEC and so on. Leveraged ETFs also suffer from long-term NAV erosion, but for very different reasons. So when it talks about hedging volatility, let's go ahead and pop into the charts here. I'm going to go over this one more time with you guys. So I did mention this in a previous video, and I will leave this video in the description below so you guys can see it for yourself. Basically, 5 ways to offset NAV erosion in the YieldMax funds. So I'm going to go ahead and pop the Tesla chart over to the weekly. What you guys can do, and I'll just use Tesla here as a quick example, what you guys can do if you're worried about NAV erosion. As you guys can see, the fund kind of fell here. But again, if you look at the charts side by side, the reason why the fund fell is because Tesla fell. You guys got to understand this about the YieldMax funds, okay? A synthetic covered call strategy is designed to replicate the price action of the underlying asset. So whatever Tesla is doing is what TSLY is going to do, okay? And that goes for any of the other YieldMax funds. So as you can see, these are both on the weekly. Tesla goes down, TSLY goes down, Tesla goes up, TSLY goes up, Tesla goes down, TSLY also goes down, Tesla goes back up, TSLY goes up, and so on and so on. It's literally doing exactly what Tesla is doing, just not as much in price swings because, again, the upside is capped on these covered call ETFs. So what I was going to say is I did mention before that one way to offset the potential of NAV erosion is you guys could basically either look to be buying at support levels or buy at a discount and or dollar cost average on your way down. So when you buy at support, you minimize the risk of being in a drawdown or being the price being below your cost basis, whatever your cost basis is on the platform that you use. And that improves both your upside potential, and the yields also boost the upside potential as well. Another way to do it is to dollar cost average down. The more you DCA down, like let's say you get in here, but you want a dollar cost average down, your cost basis might be somewhere in the middle at like 16 bucks. If we go over to my TSLY holdings right here, give me a second before this thing kicks me out. Got to go back to TSLY. As you guys can see, my cost basis right now is 17 bucks, so it's a little bit high. But my cost basis on Robinhood is actually roughly around, I think, $14.50 or 15 bucks. So how much you're in a drawdown kind of depends on where you get in initially, how much capital you put in, and whether you buy on the dips or not. If you put a lot in at the top and you're not buying on the dips, well, you're going to be in a drawdown. If you put a little bit in at the top and you DCA down, you may still be in a drawdown, but it might not be as much. If you wait to bulk buy at the bottom, then the amount of drawdown that you're going to have is very little, and you're going to get paid more dividends because you bought cheaper share prices. And so both the upside potential and the dividends are going to massively outclass basically what's referred to as NAV erosion. What we consider to be NAV erosion would basically be comparable to being in a drawdown. So as you guys can see here, our current value is 77.20. This is just TSLY. Our cost basis is 9,300. The market share price is 14.05. The average share price is 16.97. Again, the reason TSLY dropped is a number of different things. The Fed's still raising rates. Elon Musk came out and said, or Tesla came out and said that they were basically going to reduce the sale price of the Teslas, mainly because of demand destruction. You know, the Fed's raising rates, so it becomes more difficult for people to borrow $100,000 to go buy a Tesla car. You know what I mean? So they want to make it available to the masses so they can get mass adoption. Tesla can become a bigger company. In the short term, it's bearish, but in the long term, it's bullish. So as you guys can see, the dividends here, it does actually kind of offset the drawdown in market gain. This dividend amount actually includes the amount that we're going to get paid on the 19th of this month. So on the surface, it looks like I'm down about 1,600 bucks unrealized losses on this account, okay? And again, when you're in a drawdown, it's only a loss if you sell. If you don't sell, you didn't lose anything, okay? You're in an unrealized gain, or I mean an unrealized loss, and you're simply in a drawdown. But if you sell, then it becomes a loss. And the inverse is also true. So on the surface, it looks like we're down $1,600, but that's actually not true, because if we do the math here, so we'll go ahead and calculate this. So 9323, 9323 minus 7720, 1,600, okay? But we add in the dividends, and, well, okay, yeah, we actually did that a little bit wrong here. So I think it's actually supposed to be minus, so minus 888. So we're really only down about $715, truthfully, because the dividends are offsetting some of the drawdown that we're experiencing in the funds. So there's that. We did actually take some profits. It doesn't show here because, again, the price is below our cost basis, but we did actually take, I think, about $300 or $400 in profits on TSLY as it was pushing to the all-time highs. Up here, we started taking profits up here and then buying and averaging it down into this drawdown here. So there's that. One option is you could just buy at the buy at the bottom. Another option is you could buy a little bit at the top and then DCA your way down to avoid NAV erosion or having a drawdown. And another option that I'm going to mention that I did actually say in that video that I'm going to leave in the description for you guys below is you could actually take some of the profits and or dividends that you receive from TSLY and you could put it into Tesla. I mean, it's literally just that simple. So we'll take a look at some of the moves here. So this little area right here would be basically the start of Tesla's run up, TSLA, okay, not TSLY. So on TSLY, you would have got about a 38% move. But if you were buying at support on Tesla, you would have had about 171% move. So if you had, let's say, $1,000 in TSLY, but $500 in Tesla, the upside potential that you would receive on Tesla would offset most, if not all, of the drawdown and or NAV erosion that you would have on TSLY. So at the very worst, you'd be at break even or potentially even be in profit, okay? Now, if we go to the NASDAQ.com, we'll take a look at the TSLY dividend, which, of course, everybody's favorite is TSLY, so that's why we're using this one. It shows here 70%, so that's actually not accurate. We're going to go to the YieldMax website to look at this. So you got a 49. We'll just round it up and say a 50% dividend yield. Okay. If we look at the chart of TSLY, so from this resistance here down to the hold on, give me a second. So from the top of the resistance area down to the bottom, you would have had about a 32% drawdown. Let's just say worst case scenario, you bought the entire amount at the top and you did not dollar cost average at all on the way down to support. Well, you'd still technically be in profit. Reason being is because you had a drawdown here of 32%, but you're getting paid a dividend yield of 50%. So the yield is outpacing the drawdown as of right now. So I've given you guys some options as to what you can do. You can also take some of the dividends. I've given you guys some options as to what you can do to offset the NAV erosion or drawdown in TSLY or other YieldMax funds. Another thing that you guys can do is you can take some of the YieldMax funds and invest them into dividend growth stocks. Okay. So like if you took TSLY and you invested some of the dividends into PepsiCo, let's say you're going to get a dividend yield that's a lot lower than TSLY, but you'll also get some pretty massive upside potential. So you could basically take those dividend payers from TSLY and put them into high growth names like Pepsi or Apple or Microsoft or something like that and get a dividend yield that's slightly less. So I'll leave this in the link as well. According to Investopedia, this is basically the snapshot of what a covered call strategy is. So you get limited upside potential in terms of profit. You have a break-even point known as the strike price, and then anything below that is potential loss. So if we go back to TSLY here, we'll take a look at TSLY again. If your upside is 50%, let's say that basically, we'll draw a line here. We'll say that this little area right here is your upside from this green bar all the way to the top of this blue bar, and your downside is from, well, okay, we'll move it down a little bit to be more realistic. And your downside is from this green bar to this green bar. Well, that's pretty much a covered call strategy. So you get about 50% of the upside or capped appreciation, exactly as it says in the YieldMax funds, and potential 100% of the downside. Well, what could cause the price of these things to go back up is that the S&P goes into a new bull market. And I can tell you guys right now, as long as the Fed continues to raise rates or hold rates at higher for longer, there is hundreds of billions, if not trillions of dollars in hedge fund money and institutional money and extremely rich whales out there that have hundreds of billions of dollars of net worth, whether they be individuals, families, or companies. And all that money is sitting in cash and treasury bonds right now. Why? Because cash and treasury bonds are paying a 5% yield with essentially risk-free money. Cash is insured by the FDIC, I think up to like $250,000 or something per account. Excuse me. And treasury bonds are basically more or less guaranteed by the government, okay? That it's backed by the, quote, full faith and credit of the United States government. So there's very little risk for them to be in these 5% yielding bonds and cash, compared to, say, potentially a 38% pullback on TSLY or maybe a 70% pullback on Tesla. Why would they want to put their money at risk of all those losses or unrealized losses when they can just simply wait for the Fed to cut rates and or start quantitative easing again and print money? And then at that point, they'll know that the bottom is in, the Fed is bullish again, and then they can put their money back into the markets. So this is the risk that you take by investing your money during a Fed tightening cycle. That's just simply the way it is, guys. I've studied this stuff for years. I know what I'm talking about here. Okay, I've seen it time and time again. So let's get into some other metrics here. We're actually going to go to the YieldMax TSLY or TSLA option income strategy prospectus. This is the prospectus for YieldMax funds. You guys can basically find it by going to the YieldMax website, click on TSLY, and then scroll all the way down here, click on prospectus, and that'll show you where to go. So the important thing is I want to show you guys that it took me a while to find, but this is basically it right here, okay? So we're going to read this piece right here. An investment in the fund is not, again, it is not an investment in TSLY. Why is that? Because they're using synthetic covered calls. They're mirroring the price action of Tesla exactly like an index fund would mirror the price action of the S&P 500. It's exactly the same thing. Maybe not exactly the same thing, but the concept is the same. So the fund strategy will cap its potential gains if Tesla shares increase in value. The fund strategy is subject to all potential losses if TSLA shares decrease in value, which may not be offset by income received by the fund. So again, we're going to go with our theory here. 50% upside, 100% downside. Good ways to protect yourself is to wait to buy at support, dollar cost average on the way down, reinvest the dividends, which would offset some of those potential losses and reduce your cost basis. You could use some of those dividends to buy the underlying share, like Tesla, for example. You could use the dividends to buy, trying to think of what else. You could use it to buy index funds. You could use it to buy dividend growth stocks. You could use the dividends to buy crypto for the next big crypto bull run, which would not give you a return on your money immediately, but in about a year and a half, it would offset that NAV erosion possibility in the short term. There's a lot of different options that you guys can use to help avoid or hedge against the possibility of NAV erosion. All right, so that pretty much covers this video for today. I hope this helps in some way. Again, I will leave these links in the description for you guys below, and the video about the 5 ways to offset NAV erosion in YieldMax funds down below. Hope you guys appreciate this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.